Is Tesla the best company you can buy right now, or is it all Elon hype? In today's video, we'll do an in-depth analysis of Tesla stock. I'll cover the most critical aspects of business operations, fundamentals, and technical metrics. Now we'll dive into Tesla's business operations by segment and geography, according to their annual report, to determine how they generate revenue. Tesla is primarily an auto manufacturing business with 95% of their revenue coming from the segment titled Automotive and Services, which includes automotive sales, leasing, services, and other. The other 5% of their revenue comes from energy generation and storage. So their primary business operation by far is producing automobiles. By geography, Tesla divides their revenue into three regions: United States, China, and other. The US comprises 50%, China comprises 22%, and other makes up 28%. Or we could think about their revenue as 50% domestic and 50% international. We can also see that China makes up a large portion of their revenue as an individual country, which we'll come back to later in this video. Now let's cover the macro level benefits or pros of buying into Tesla. One of the most obvious benefits to Tesla is their current popularity and fandom of Elon Musk. Teslas have become a status symbol, and Elon Musk is seen as a modern-day genius and visionary who people want to be associated with. Elon is the most followed person on Twitter, leading big names like Obama and Justin Bieber. Tesla is almost always the most talked about stock on Twitter and is continuously in the top 10 mentioned stocks on Reddit too. This is all free publicity for Tesla and inevitably leads to sales. The governmental adoption of electric vehicles is also a sales growth catalyst. 27 European countries offer tax benefits and purchase incentives for electric and plug-in hybrid electric vehicles, ranging from free use of toll roads to tax credits worth thousands of euros. China and the US also offer significant tax credits for electric vehicles. With growing incentives like these across the developed world, people will continue to adopt electric vehicles. Another prominent benefit of electric vehicle ownership is not being subject to the high price and volatility of gasoline. Through buying an electric vehicle, you can purchase electricity from the grid or produce your own, which is far cheaper than using gasoline. Not to mention that electric vehicles require far less maintenance compared to a petrol counterpart. Furthermore, electric vehicles are vastly more efficient than gasoline motors. And in the case of Tesla, they are some of the most aerodynamic vehicles that are mass-produced. Although most of the benefits just listed aren't specific to Tesla alone, rather electric vehicles in general, which we'll come back to later in this video as a risk to Tesla. Some benefits that are specific to Tesla, though, is their unmatched vehicle safety. Teslas are some of the safest vehicles on the market. In 2023, the Insurance Institute for Highway Safety awarded the Tesla Model Y the top Safety Pick Plus in the mid-sized luxury SUV category, which is the highest safety distinction a vehicle can earn. In 2022, the Model 3 was given the same rating in the mid-sized luxury car category. In Europe, Teslas also topped the charts for vehicle safety. Teslas made up 3 of the top 6 spots for the best-in-class cars of 2022. According to the Euro New Car Assessment Program, people care about safety data, and it is the most important criteria when purchasing a car, according to a survey of 10,000 Americans. Now we'll look into the macro level cons or potential risks of buying into Tesla. There are a few significant ones to consider. The first risk is that the auto industry is highly competitive and there are so many consumer options for purchasing a vehicle. Initially, when Tesla first gained popularity, they dominated the electric car market and there was no significant competition at their scale. But those days are over and there are now countless auto manufacturers that are cutting into Tesla's market share, and those competitors will continue to develop their electric and hybrid cars. On the note of hybrid cars, that leads me to another risk of Tesla ownership, which is that they sell only electric cars, while other auto manufacturers like Toyota are able to blend the benefits of internal combustion engines and electric motors, which will potentially appeal to more customers. Another significant risk is that they make autonomous vehicles that have already resulted in death and bodily injury. Tesla is currently in litigation for cases like these and anticipates they will be into the future, as seen here from their annual report. This could lead to billions in losses and poor performance like it has for 3M. A more subtle risk of the business is that without Elon, the company may lose efficacy and popularity. Elon has been the driving force for Tesla's success, and without him, Tesla could plummet in the same fashion, which is a risk that Tesla states on their own annual report. Another risk we'll cover is their reliance on sales in China. China represents 22% of Tesla's total revenue. The US and China aren't on the best terms, and if we were to have conflict with China, Tesla would take a huge hit to their revenue. Additionally, Teslas have actually been banned from driving in certain areas of China under the preconception that their cars are capable of covert data gathering, which the Chinese government is attempting to block. Bad news for Tesla. Lastly, the auto manufacturing industry is characteristically cyclical, which we can see here through Toyota's revenue as well as Ford's, which never recovered. Now we'll look into the competition to Tesla. I think this may be one of the most critical aspects of the video, which is that there are so many good vehicles to choose from that aren't Teslas. Vehicles that offer advantages like the ability to refill anywhere, along with great economy, like the new Toyota RAV4 Hybrid, which combines the benefits of electric and gasoline vehicles, or all the other electric car options that are currently on the market like these. This is my main concern when considering investing in Tesla, wondering if they have the ability to maintain their market share after the popularity buzz. Now we'll check out the most meaningful metrics when analyzing a business, including revenue, net income, free cash flow, cash, debt, and shares outstanding. We'll start with revenue per share as the first flow of money into a business. I like to look at 5 years of data because it gives a relevant but longer-term picture of company performance. Here we see revenue per share, which is growing at a mind-boggling rate, a compound annual growth rate or CAGR of 25.4%. This revenue growth is one of the main reasons behind the Tesla buzz. Now we see net income per share, which tells a similarly outstanding story. Although we can also see that Tesla has only recently become profitable, beginning in 2020. Their CAGR for this period was 60.3%, which I have yet to see in another company during this period. Here we have free cash flow, which, if you're unfamiliar with, is a more true bottom line than net income. It's grown from just 12 cents per share to $5.16, or a CAGR of 112%. Outstanding. This is Tesla's cash on hand, or cash and short-term investments. I use this metric as opposed to assets because assets can be misleading, and much of these so-called assets won't be sold and are generally essential to business operations. Tesla currently has $23 billion as of their last report, which has grown from $3.7 billion in 2018, a CAGR of 43%. This is a fantastic growth rate and is one indicator of good financial health. But wait to see the story develop further and take a turn. Next, we have total liabilities, currently at $38 billion, which has grown from $23 billion in 2018, or a CAGR of 10.6%, which is a good sign as their cash is growing at a far greater rate than their debt. The last fundamental metric we'll look at, unrelated to price, is shares outstanding. Shares outstanding is another critical proxy for financial health. Tesla has grown their share count substantially, or by a CAGR of 6.3%. This is a red flag, although share dilution is typical for newer companies. If you want a company that continues to reward shareholders through share buybacks, Visa is a better option, which I have a video on linked below. Now we'll go over some fundamental metrics related to price, starting with the price to earnings ratio. Tesla's trailing 12-month PE ratio is currently 75 as of September 20th, 2023. This is an extremely high PE ratio and indicative of Tesla being overvalued, but doesn't tell the whole story by accounting for their net income growth rates. So to account for Tesla's insane growth rate, we have to look at the price to earnings growth ratio, or PEG ratio, which compares the PE ratio to the earnings per share growth rate, which in 2022 was a fair 1.08. The general conception here is that a PEG ratio near or below 1 indicates a good value. So by this metric, Tesla is a good value. In this segment, I typically compare a company to its peers, so I determine who the other big electric auto manufacturers are, which are BYD and Volkswagen. Comparing them by PE ratio, we see that Tesla is trading at a much higher valuation than its peers, but is also growing at a much faster rate than each of them, especially Volkswagen, whose net income has decreased over the past 5 years. This is the flaw with the PE ratio. It doesn't account for net income growth rates. Now we see the total return of the three companies, and Tesla has vastly outperformed BYD and Volkswagen with a 5-year total return of 1,236%. In summary of the fundamental analysis, Tesla is growing at a world-class rate in terms of revenue and net income. They have substantial electric car market share, and they make incredibly safe vehicles, although they face lots of competition from all the other big auto manufacturers. If their growth were to slow, they would be vastly overvalued and could lead to a price drop. Here we see a 5-year price chart for Tesla, and the first component to note is the price trend. We see over this time frame the price is trending up at a rapid rate, which is ideal if you're buying the stock. Next, we see the standard deviation channel marked by the top red line, middle tan line, and the green lower line. This tool enables us to determine how far price is from average given a particular time frame, and the average is marked by the middle tan line, and price currently is only slightly below average at 14% below the middle line. In terms of support and resistance, the price recently bounced off a prominent support level around $205.
and the next meaningful resistance level is around $310, which are marked at these two red lines. So price is in the middle and will likely act off of one of those price levels soon. Additionally, price often acts off of the middle standard deviation line as either support or resistance, which it is approaching. Lastly, we have the relative strength index, or RSI, graphed at the bottom of the chart. When the white line is at the top of the channel, the price is coming into an overbought level and may be set for a reversal, which is the case with Tesla currently. In summary of the technical analysis, Tesla is trending up rapidly, but is only slightly below the middle standard deviation line, or average price, and is in between two prominent support and resistance levels. Furthermore, the RSI indicates that price is coming into an overbought level.
Let me know if you think I left anything out of the analysis, and if you enjoyed the video, please leave a like. If you want to see my trades on Patreon, the link is below. Thank you for watching.